Hello and assalamu alaikum everyone. In today's lecture, we're going to talk about factors affecting the choice of source of finance. Like, what are the factors that affect your choices? What are the factors that you think about? What are the things that you have to think about when you're deciding which sources of finance are more appropriate and which are inappropriate in your given situation? So, for discussing this, there are actually a lot of factors that you have to look at. So, I'm gonna break this video up in two parts. The first part we're gonna discuss half factors, and the other part we're gonna discuss the later part of that. So, before diving on the factors, let's just have a small discussion. Like, what are the questions that you have to ask before deciding? So, first thing is, what purpose is it required for, and how much amount is required? Surely, if you want it for long term, for short term, that's what basically determines your amount that you are going to take, and what purpose is it, what specific purpose it is required for. Because for some purposes, maybe there are some special sources available, like if you are want to have machinery or technology is required, then hire purchase or leasing is more important, more appropriate source of finance. So in that situation, you can go for hire purchase leasing. We're going to talk about that. And legal structure of the business is also one big factor that affects your choice of finance. And in today's lecture, we're going to focus mainly about the legal structure of the business with some others. So some structures have limited sources of finance, and others may have wide choice of sources of finance. What is the existing debt situation? That is the gearing. It's an edu term for gearing, so you don't have to learn the word gearing perhaps, but it's good if you know the term. And even if you mention the gearing term in your AS exams, you won't be penalized for the marks. You'll still get your marks. So basically, what is the existing debt? If you already have lots of loans, should you go for more loans or some other sources? How long will it last as a short-term source, or short-term or long-term use? So availability of other sources without repayment or interest, like if you don't want to give loans, so if you want some investments, perhaps like grants, might not have to repay. Venture capital and crowdfunding, you just have to give some, let's say, the profits, some percentage of your profits. So these are beneficial if you think that the project is too risky, that you might not be able to repay them if the business fails. So in those particular situations, they might be useful. How much retained earnings does the business have? Does it have enough retained earnings so that it can finance itself? If it doesn't, then what external sources of finance does it have to look after? Does it have idle assets which could be sold? So it may not be a good option if the business is growing, as it will eventually need those assets. Is it possible to issue shares? Like if it's a public limited company, then it could issue shares, but remember that issuance of shares is our last option. And finally, is borrowing is easy if a firm has a track record of for success. So if you have a good record, you have a reputable business, then perhaps loans might be a good option as well. But that was just a small discussion. Now let's move on to the main topics. So we just divided them into points, and we will discuss each of them. So first factor is the time period. That is, capital expenditure is generally for long term, or revenue expenditure, or you can say short term. Okay, so that's the basic two choices that you have. The period for which finance is required determines the suitable sources available to the business. For instance, where funds are required for shorter period, like funding revenue expenditure or managing your cash flow, bank finance like overdraft, cash credit, leasing, or debt factoring are appropriate sources of finance. So if you want to manage your cash flow, that is your short-term need. So short-term sources of finance like overdraft, cash credit, and in fact debt factoring are more appropriate. And if you just want to fund your revenue expenditure, that is also for like short-term needs only. It is also included in the short-term needs, like purchasing fuel for your vehicles and maintenance costs for your machineries, etc., and paying off your employees. So all that you can do with these resources. Alternatively, if a business is looking for long-term uses like expansion or funding capital expenditure, when we say funding capital expenditure, it means like purchasing machineries or factory. Sources like share capital, that is of course exclusive for PLC, debentures, mortgages, long-term loans, or even crowdfunding and venture capital can be used. Okay, so all these sources are also appropriate for long term. So the first thing is, what's the time period, and based on that we can just keep cutting down our choices, and then we might be left up with one or two choice. Okay, next up, the flexibility. Some sources of finance are highly flexible and hence can be adapted to meet businesses' precise needs like overdrafts, which can be used anytime and the business can draw as much amount as it requires, of course up to a certain limit, but there's a lot of flexibility in overdrafts. But on the other hand, grants, these are inflexible as certain conditions need to be met, such as giving employment to a specific number of people, which may be costly for a business if labor is expensive or unskilled and capital intensive production is easier to adopt and helps to match your competitors. So in such situations where your labor cost is rising and alternatively you could use capital intensive production to which might be easier to adopt and help you match up to your competitors, then why would you want to employ labor force, right? So in that particular case you won't be able to fulfill the conditions for grants and hence you won't be able to use it. So that's why it is a very inflexible source of finance. So we've just talked about two sources, like the time period. How does time period affect it? Time period basically just divides your sources of finance into two parts, and after that you can just look at your other needs and then we keep cutting that. So after that we have your flexibility. If you want some flexible source like overdrafts, that can be used for your particular needs, and grants only, these are very inflexible source, and only when you can meet those particular situations, those particular conditions set out. Moving on, today's main focus, that is the legal structure of the business. Now the legal structure of a business is a major influence on deciding sources of finance that are available to it. The major implication of a business's legal structure is that only public limited companies are able to sell shares, so that alone is able to signify the importance of legal structure as a factor for choosing your sources of finance. So many startups consist of sole traders and partnerships, which usually have limited range of sources of finance to draw upon, as they represent a greater risk to potential investors and have few, if any, internal sources of finance for use. Limited companies, on the other hand, have wider range of sources of finance. So that was just a small introduction about how unincorporated or incorporated businesses, just being an unincorporated business, have limited range of source of finance, while incorporated business have a wider source of finance. And we're going to talk about each legal structure. What are the possible sources of finance for each legal structure? So first of all, we have sole traders. For sole traders, the possible sources of finance are your owner's savings, that is similar to your retained earnings, but we don't say retained earnings for sole traders or partnerships because they are not limited companies. So for those, we'll just say owner's saving or partner's savings. So keep that in mind. Next up, we have bank loans. Bank loans are, of course, traditional bank loans, the most common source of finance, but it has certain restrictions to it. Of course, same thing for overdrafts and microfinances. These are particularly for small businesses, and since most small businesses are sole traders, then of course it is very beneficial for them. And grants as well, because grants are generally for startup businesses, for those who particular some condition need to be met. So sole traders can also get grants. Now they have severe restriction on the amount of finance that can be raised. When we say by they I mean sole traders, just in case you are wondering who they. However, there are certain restrictions to it, like generally they don't have enough security, that is, you don't have enough assets to offer as collateral for secured loans, hence might only get unsecured loans. So we have already talked about the difference between secured and unsecured loans. So unsecured loans have a greater rate of interest, so that might be a more costly for sole traders, and small overdrafts might not require collateral, but banks don't agree easily. So you might be able to get small overdrafts, which will be helpful since they don't require collateral, but the thing is that banks don't agree easily to that. And another big thing is the cost, but we're just looking at the sources of finance available to each legal structure, not looking at the cost right now, just about what sources are available. Lack of reputation, creditworthiness, and good business plan generally prevents banks from giving loans. So all these sole trader generally has lack of reputation, it doesn't have any creditworthiness, and it doesn't have good business plan either. So all of this prevents your banks from giving loans. Owner savings generally not sufficient enough to meet the needs of the business. So normally whatever the saving that the owners have made, it is sometimes not even able to start up their capital, let alone be able to fund its revenue expenditure or capital expenditure, etc. Loss of control by owner. If more partners are added to raise finance, that is, you can raise more finance by changing your legal structure, but that means you lose your control. Microfinance can be used for small loans, however, may not be sufficient at times. So yes, microfinance is easily available for sole traders, but it might not be sufficient at times. And another restriction for microfinance could be that sometimes it has a high rate of interest than traditional loans because of some loan shark companies. It's called loan sharks. And government grants may be available, however, sometimes they have stringent conditions attached to it. So because of that as well, a sole trader might not be able to adopt grants. So we've talked about each of the sources, but like we've talked about how much restrictions do sole traders have and difficulty do they have in selecting your source of finance. They already have such limited sources of finance, and in those as well there are certain restrictions. But it's not like they don't have any source of finance. They can somehow agree to bank loans or overdrafts. They do have some microfinance, but yeah, there's the cost attached to it and other things. Then moving on, we have partnerships. The possible sources of finance include partner savings, loans, grants, overdrafts, and microfinance. You will see this just the same thing as your sole trader, but the only difference being your partner saving, that is, there are more people, so there's an increase in your owner's savings, like your retained earnings, that is. But of course we don't use the term retained earnings for unincorporated businesses, but the point is that you have more savings now, but still there are certain restrictions. The same thing, like the savings might not be enough to meet business needs. The problems of introducing new partners, that is, if you introduce new partners, the profits need to be distributed. On conflicts could arise in decision making. Why would you introduce new partners, some of you might ask, but that's for, of course, raising more finance. Adding new partners is also a sort of source of finance for partnerships. Generally lack collateral, similar to sole traders. So of course lack of collateral means you can't have good loans or overdrafts, and even if you do, then there's unsecured, there's high rate of interest, etc. It can form a limited company instead to widen sources of finance. However, legal formalities, etc., need to be met, which makes it difficult for them. So of course you have to. We have already talked about these legal structures in Unit 1, Chapter 2. So you can look at that 1.2. Why it's so difficult for them. Then you have public limited company. Public limited company, on the other hand, has greater access to different sources of finance. You can say that this the particular legal structure that has the access to the most sources of finance. Like it has access to almost every other source of finance. Like a wide sources of finance are available for them. Wide range of sources of finance are available. It has legal rights to sell shares to the public, and thus have the potential to raise significant initial and new investment capital. This share capital is generally used for expansion. That the share capital is exclusive to public limited companies, so you can use it for expansion, but it has its own limitations, like control. A business could lose its control, and we're going to talk about control in the next lecture when we talk about other sources of finance, other factors, and control is one of the factors as well. Public limited companies have great credibility and availability of assets, which implies that most public limited companies could offer collateral to banks for secured loans, which have low rates of interest. So yeah, they do have good credibility, so they can easily they have collateral, they could have secured loans at low rate of interest as well, and they also have access to long-term sources like debentures, mortgages, and long-term loans more easily. So all these sources are available for public limited companies. Lastly, we have private limited companies. It largely depends on size and status of private limited companies, as it ranges from small to large private businesses. So private limited companies are generally not too big or not too small. Generally it varies a lot. Like private limited companies is the single most legal structure that has a wide range of sizes. It can be small, it can be medium, it can be large as well. So it can take secured loans and overdrafts from banks due to credibility and availability of assets to offer as collateral. However, not all private limited businesses can offer collateral, as it may be a small firm and hence may need asset for its own use. It can use retained earnings and raise finance from its existing shareholders. It can also seek out venture capital for new risky products. It cannot raise finance through issuance of shares, since shares are not listed on stock exchange, so that's one limitation it has. And finally, it can convert to PLC to raise finance by issuance of shares, but risk of losing control over the business. So these are all the sources of finance that are available to public limited companies, and how it uses them. Sorry, we are out of time. Thanks for watching. Allah Hafiz.